Good afternoon, Fort McMurray. It's Melanie Gallia, and I am the co-host of Let's Talk Lending. I'm a real estate agent with RE/MAX Fort McMurray, and I am with my lovely co-host,
Barb Pinsent, a mortgage broker with the Mortgage Center We Connect.
Awesome. Okay, Barb, so we get together about 8 times a year so that we can talk about the Bank of Canada rates. The Bank of Canada makes an announcement 8 times a year about what they're going to do about the rates.
And again today, no change, which was fully expected. So, we have this same conversation and it's been the same way for quite some time now, but sometimes it's a good thing when it doesn't change, and that it didn't change again this time is good because, the overnight lending rate is still at 0.25%. So for those of us who have variable rate mortgages or lines of credits or things whose interest rate revolves, our rates are not going to change.
Gotcha.
A little bit of it, they're expecting a change to come sooner now than was originally forecasted. Like the last time we had our meeting, they were expecting it would be the latter part of 2022 or early 23 before we see a rise in the overnight lending rate, but the economy is doing better than was forecasted. So now they're saying it could be, mid 2022. So nobody ever knows. Like, you can't ever put too much stock into, to what you're seeing or hearing, or because it changes so quickly. But because last month it was going to be the end of 2022 toward, mid 2023 before we would see a change. That said, they don't know what the impact of this next lockdown is going to look like. So, but the economy does seem to be recovering quickly, even after the last lockdown. Things are recovering more quickly than they expected. So it's good news.
Yeah, well, that's great news.
Yeah.
We have heard talk, though, like the last time we just did a little preempt. Have you heard any more confirmation of the actual stress test change? Is that happening for sure yet? Do we have any verification of that yet, or no?
No, nothing. I haven't heard anything since that was announced. And because they're going to put it out to whomever for comment, and I don't remember the dates. I think it was like they have until May 7th, if memory serves. Yeah. So no more has been said than was originally reported to us. So we have to wait now until probably May 7th, it'll be shortly thereafter, but it'll be sometime in May when we hear. And again, the changes, if implemented, will be effective June 1st.
Gotcha. Okay. If you have any questions for Barb and I, please feel free, type them in the chat. We'll get them answered. But this episode, Barb, you wanted to talk about, I think it's an important topic. It's a really important topic. And so today you're going to be talking about
debt servicing. And we're talking insured mortgages. Insured mortgages work a little bit differently than conventional. So when you have an insured mortgage, typically you're putting less than 20% down on your purchase. And those mortgages are in default insured. And we now have lender guidelines to follow and insurer guidelines. So it's the insured mortgages that I'm talking about today.
Okay. So, and that's when you need CMHC or SAGN or Canada Guarantee.
That's right. Yeah.
Okay. All right, Barb, take her away.
Okay. So what is looked at when you're being given a mortgage is debt servicing. And so these debt service ratios are used by lenders and default insurers alike to measure your ability to repay the mortgage, ensuring that your total debt, which includes your car payments, student loan payments, credit card bills, they want to make sure that those payments and your housing costs don't exceed a certain percentage of your income. So it's your debt payment and housing costs divided by your gross income. And those are the numbers that they look at when looking at debt servicing. If the percentage of debt to income exceeds the maximum ratios allowed, your mortgage request is going to be declined. And we don't even want to go to that point in time. You're going to check with the broker to make sure that, or with a mortgage specialist to make sure that your numbers do work so that you're not exceeding those guidelines. And there are 2 ratios that are used to determine how much mortgage you can afford. Gross debt servicing is the percentage of household income that covers housing costs. GDS, also gross debt servicing, also known as GDS, can't exceed 39% of the household's gross income. And these are Sagen, not CMHC doesn't follow these same guidelines exactly. But, as long as we have an insurer who will, then we can go to the maximum, which would be 39% of your household's gross income. And housing cost, also known as PITH, principal, interest, taxes, and a heating component, can include your principal and interest payment, property tax payment, heating, and heating is based on square footage. And if there are condo fees, 50% of whatever the condo fees are used in our debt servicing numbers. Total debt servicing, also known as TDS, is the percentage of your household income that covers your housing costs and any other debt that you might have. TDS can't exceed 44% of the household's gross income. And debt payments that are used to determine TDS will include the monthly costs for your housing, so your principal, interest, tax, heating, and condo fees if applicable. Credit card balances, if there are balances owing to credit cards, we have to use 3% of whatever the balance for our calculation. Line of credit, same thing, 3% of the outstanding balance. There are some exceptions to the line of credit if the limit is over $50,000. Most of us don't have a limit over $50,000, but if you do, we don't have to look at that 3% of the outstanding balance as a minimum payment. Personal loan payments, student loan payments, support payments, if you're making those, all considered in the total debt servicing. So if you are looking at a place that's listed for $500,000, and I'm doing this based on a scenario here in Fort McMurray, so property taxes, and it like a guesstimate, but about $208 a month. Heating, again, by square footage, and for this property, the cost would be about $100 a month. Not a realistic figure always, but what we can use when we're determining ratios. And then a payment based on a stress test of 4.79 is the rate that I'm using for this scenario. So you'd have a payment of $2814.36, and based on 5% down, a 25-year amortization, and of course, again, it's an insured mortgage. So you've got total housing costs of $3122.69. So in order to qualify for that $3122.69, your annual income would need to be $96,082.85. Exact numbers, and it's just nature of what I do. So I don't round up or down typically. So and to determine what you need in that 39%, the math is the payment times the 12 months in a year divided by 39%. So that's how we arrive at that figure. And now we're going to take a look at what the picture looks like. So this same $500,000 purchase, if you have debt. And I'm just going to throw some numbers out there. So if you had a balance on a Visa of $4,500, 3% of that 4,500 is 135 a month. If you have a vehicle payment of 525 a month, and we're going to put in that mortgage payment of housing costs, sorry, of the 3122.69. So in total, that's 3782.69 per month.
Yeah.
So now our total debt servicing can go to 44%. So in order to determine how much income you need on that $500,000 purchase, as you can see, you need a little more now because it was 96 some earlier. With the payments that are the vehicle payment and that credit card balance, the income now needs to be 103,000 or just over 103,000 to qualify for that same $500,000 purchase. So with payments totaling to creditors of $660, the numbers have changed, requiring the household income to now be $103,164 from the $96,000 for that same $500,000 purchase. So you need $7,000 more a year if you have outside debt to buy that same house. To determine how much mortgage you qualify for when you're looking at the household's annual income, same ratios are applied. So you take the household income by 39%, divide it by 12 months. That's going to give you the maximum payment amount that your housing costs can be. And then you take the household income, 44% of it divided by 12 months. And that's what your total, like the payment for the total debt servicing. So housing costs, any other payments that you might have. And once you start running out of room there, you don't qualify for that $500,000 purchase.
Gotcha.
So if you're making $100,000 a year, 39% of that $1,200,000 monthly would be $3,250. So that's the maximum that you can have going out the door. So for your principal, interest, heating, and condo fees, if applicable. The 100,000 divided by 44 leaves you with 3666 maximum going out the door monthly. So you're going to take away the 3250 already, and whatever the difference is what you can have in other debt. Can't be any higher than that. If it is, ratios are exceeded. And I do have a tool that's quite handy, and it's a mortgage app, and it will calculate the numbers that I just did for you. So you can put your income in there, and it'll tell you how much the maximum mortgage it is, you qualify for based on stress test, based on how much down payment you have. It will do the closing costs, and it's specific to Fort McMurray. So the numbers aren't exact, but they'll get you pretty close to actual numbers. It'll pre-approve you. It shows what interest rates are. So it's actually a really great tool. So if you're interested in that, you can download it to a handheld device using the link that shows here.
Perfect. Awesome.
And that's
yeah. So people want to get a hold of Barb and I, you can go to letstalklending.com, get yourself registered there. If you have any questions, listen, this isn't the sexiest topic, right? But it's important information to know and understand when you're purchasing, because you need to know what your buying power gives you. You need to know the importance of getting those credit card bills paid, getting your car paid off as soon as possible so that you can decrease the amount of debt that you have to increase the amount of property that you're able to purchase. There's lots to know. And that's why I can't stress enough the importance of making sure that you're not just, that you are pre-approved before you step into any seller's home or property that you want to purchase. It's just so vitally important. Properties are selling very quickly, right? So our current inventory, I just did a couple of numbers here. We've got 238 single family homes on the market as of now, okay? There's 55 home sales so far this month. Last month was the highest amount of overall sales, all residential sales since March 2014, which is incredible. So we're already at 55 single family home sales, and another 25 of those have offers on them already. I'm seeing more multiple offers. I'm seeing, Barb, you want to just leave that up the way it was?
Oh, sorry, Melanie.
No, that's okay. That's okay.
Would love to, only how am I going to get back there?
No, that's okay. I'm going to take it off. Okay. So here we are. Okay. So, and then I'll just put a little banner or a little ticker at the bottom there. There we go. So if people want to get a hold of us, they can go to letstalklending.com. But like I said, it's just so vitally important. You don't want to miss out on your dream home, right? Because you're not ready. And you also need a good agent to help you navigate through all of this. There's lots to know. There's lots of tactics to be used. And you need someone that's going to be able to help you through those things, right? And so I cannot stress enough the importance of the very first step before you get into a car is calling Barb, right? Calling Barb to make sure that you're prepared, that you have everything ready to go so that she can give you every single financial arsenal in her toolbox in order for you to get that home that you're looking for.
That's right. Yeah. Couldn't agree. Yeah, for sure.
Awesome. Okay, Barb, do you happen to remember? I always ask you this every single time. May is the next time?
No, not till June 9th now.
Okay. Oh, you didn't know this time. Right on. Okay. Okay, perfect. Well, Roy McMurray, hang on to your hats. The market is healthy. It's healthy. It's not a buyer's market anymore, ladies and gentlemen, and that's where you really need to be prepared. I can't stress that enough. If you're thinking about selling, call me. You know, like, what do you need to do? What does this all mean for you, and how? Like, let me show you what's going on with the statistics so that you can make the right decision for you. What do you do, and what do you need to do so that you win? So awesome. All right, Barb.
Okay. Well, thank you so much.
We reconvene in June.
We will. Yes, the 9th of June.
Awesome. All right, Fort McMurray, share this video. Get a hold of us by going to letstalklending.com. And Barb, thanks for being my co-host.
A pleasure as always. Thank you.
Okay.